Welcome back to Strongman Personal Finance. Welcome back to Strongman Personal Finance. My name is Christopher Bell. I'm a certified public accountant. I'm a long-term Boglehead investor. I'm author of the book Stop Being a Broke Loser. And at least for this week, I am a professional meat spin, meat breath, meat thrust, meat slap Kevin hater. Okay? I'm going all out on the meat spin hate because he's a freaking loser. Now, we all know what he did. He sold his entire portfolio, blah, blah, blah. Timing the market. He's a moron. We all know that. Buy my course. Buy my course, bro. We all know what he did, okay? Now, this man, David Lee, I think his name is Dave Lee. I've never heard of him. He's got kind of an annoying voice, but at least he's intelligent, at least to a degree. Apparently, Dave Lee here brought on Meat Breath, Meat Spin, Meat Slap Kevin. And Dave Lee confronted Meat Breath about why he sold his portfolio. And he mentioned something very, very important that you need to really pay attention to. So let's listen to Dave ask Meat Breath an important question, and then we'll listen to Meat Breath give his amazing answer.
Yeah. So I'm curious, what's the rationale, especially with, I mean, you live in California, so I'm guessing you have some pretty big tax bills when you sell your stocks, and especially Tesla. Didn't you get in like, early last year or 2020? Actually, 2020, right? When Tesla was like really low. So does it make sense for you to sell Tesla when, for example, you have a big tax bill? Are you confident you can gain back those kind of that tax, hit and get back at a lower price?
You know what, Dave? That is a fantastic freaking question. I am very impressed. I'm not even subscribed to your channel. I don't know if you pump penny stocks or what you do, but that was a very intelligent question. The number one thing that will affect your long-term returns is taxes. And the more wealthy the more money you make, the more income you make, the higher your tax bracket, and the more you pay in taxes when you freaking sell stocks at a gain, okay? Now, you can offset gains with losses if you have losses with individual stocks. You can do that. But you still have to eventually pay a tax bill, especially if you're investing for the long run. That's why I always tell people, match your tax advantage accounts so you never pay freaking taxes again, specifically with the Roth option. But I don't want to talk about that right now. It's too much crap. Anyway, Dave asked a fantastic question to Meat Breath, because the problem with Meat Breath's actions, Meat Slap's actions, is that he's going to get a $1 million, $2 million, $3 million, $4 million, $5 million tax bill from selling all his stocks at a gain. Not only does he have to make money on the dip and go above that, but he also has to recuperate the money he's going to lose in taxes. Now, I think later on he said he paid $1 million or $1.3 million in taxes, or he's going to. That's for his liability will be in the future. How much are you going to have to make? What kind of returns are you going to have to make to recuperate that? You're going to have to make $1.3 million back. Now imagine if you didn't sell those $1.3 million or to pay those $1.3 million of taxes, and you instead left them in your portfolio and you allowed that to compound over time. Imagine how much you can make over 10, 20, 30, 40, 50 years if you didn't freaking sell and pay that $1.3 million tax bill. You could probably make a lot more money. But Meat Breath, he doesn't care. He's all about drama. This might be a whole freaking publicity stunt. I mean, knowing Meat Breath, he's all about drama and clicks and buy my course, buy my course. We all know what Meat Breath does. But let's listen to what Meat Breath has to say.
It's a really valid question. What it comes down to is portfolio building. So when you look at your entire portfolio and you say, all right, I've got $7-8 million in gains on Tesla. That's a lot. In California, I'm going to be losing about a third of that, right? Because I've got long-term capital gains taxes, and then of course I've got some of them are going to be short-term taxes, and then I've got California taxes. So somewhere between 35 and 40%.
And the net investment income tax. So there's actually a surcharge if you make a ton of extra. If you're like basically a high-income person, you pay an additional 3.8% on your gains. So he's in the highest tax bracket. If he has long-term capital gains, he's paying 20% federal. I believe California's highest bracket is 13%. I could be wrong. I don't live in California. That's 33%. And then you tack on that additional 3.8%. Holy crap, that's almost 40% freaking taxes. Now, if it's a short-term capital gain, Like, this freaking clown pays all the time trading options. He's in the 37% tax bracket for short-term gains, 13% for California. Oh, we're over 50% now. And an additional 3.8% for net investment income tax. 54% tax. Okay, this meat breath is probably going to pay about 40% of his gains in taxes. That is so freaking stupid. Especially if you're a long-term investor and you believe Tesla's going to moon. Just freaking leave it, okay? If you believe Tesla's going to go to $1 trillion a share, why pay the taxes? Let it freaking ride. Buy the stock below its intrinsic value, whatever you think it is, and just let it go. Is that so hard, Beat Breath? Let's see what he has to say.
But we have seen such a compression in valuations on so many companies, like the Matterports, the Enphases, the SoFis, the Lemonades of the world, that I was able to take some losses and reduce that.
When he says compressions and valuations, he's saying he lost a lot of freaking money. That's a euphemism. And he bought a bunch of unprofitable garbage stocks, and they all got freaking annihilated. All of them. The only reason this loser has any gains whatsoever, from what I can tell, is Tesla. This freaking moron YOLO'd into a bubble stock at, I don't even know what his cost basis was. Probably freaking insane, because I'm sure he put in a little bit when it was like very small, and then I know he was putting more and more in as it went up. Stocks go up, so I buy. And he got freaking lucky. And the only reason he has any gains whatsoever is Tesla. Only reason. Moron.
8 mil, probably to about 4 of taxable gains. So now I'm really only looking at about 33% on 4, which is around 1.2, 1.5 mil. It's really not that big of a deal. Relative to a $20 million portfolio, we're talking about 7 or 8% as an actual tax hit. And the cool thing now...
Yes, because you don't pay taxes on your cost basis, okay? When you spend $100 on a stock and it goes up to $120 and you sell it, you only pay tax on the difference between the sales price, the proceeds, and the basis of the stock. In this case, for this example, you pay tax. It's not $20 of tax. You pay tax on the $20 of gain, whatever your tax bracket is. Now, from what I'm understanding here, and I could be hearing this wrong, but it sounds like he had a net gain of $4 million on a $20 million portfolio. So, what that says to me is that he had basically $16 million of cost basis, all right? Now, if he has $4 million of gains, you take 20 divided by 16. He's made 25%. 25%, okay? And then you knock down that with taxes, whatever his freaking tax hit is, and he probably made 15%, okay? That's not that great of a gain in a freaking raging bull market. I would have to actually look at his portfolio to see what his returns were. I don't know if he's going to release his taxes. He probably never will. He's a loser. But he hasn't made that much money. He probably underperformed the index because he bought a bunch of garbage stocks that he had massive losses on, and he sold them at a loss so he could offset the gain in Tesla. Or you could buy the index, which has been up massively because it's, well, I mean, depending on what index you bought. If you bought the world index and you held it, you would have no capital losses, okay? You would only have a capital gain, and you wouldn't have to sell it, obviously, because you're a long-term investor. That's not a great return. That is not a great return. He's a freaking moron. He's doing this all for show. He's a total freaking loser. Let's see what else he has to say.
Is I was able to take this opportunity, as long as I respect the wash sale rule, and I don't go rebuy some that have lost money, whether that was Robinhood, Lemonade, or Matterport. As long as I don't rebuy those within the next 30 days, which I have no rush to do, then I can offset those Tesla gains. So the benefit here is, and I've got to, there's long-term, short-term. Always talk to your CPA about all this crazy tax stuff. But that's essentially how we've concluded or decided what to do with my portfolio.
Oh, I am a CPA, and you don't have to be a CPA. Literally, just think, you don't want to pay taxes, okay? Taxes are bad because they reduce your long-term returns massively. If this loser had just put every dime he had made into VT, he'd be up way more than he is right now. I don't freaking get it. What is the appeal of this moron? Please explain it to me. I don't get it. Anyway, that's it for this. Like, subscribe, tell your friends about me. Meet Kevin, meet Breath, meet Slap is a moron, and have a wonderful night. Cheers!